Welcome to Fred's Financial Planning Workshop. I'm Fred Smith with the Silicon Valley chapter of the AAII. The slides for today's workshop are available at our local chapter website, www.siliconvalleyAAII.org/financial planning. I've given you my email address here in case anybody has any questions or wants to leave any comments. Topic for today will be taxes. But first, we have our standard disclaimer, which basically says that all the views today are mine and not necessarily those of either the AAII or our local Valley chapter. These financial planning workshops cover a broad range of topics. We've already had workshops on investing, and today we're covering taxes, and in the future we're going to be doing a couple of workshops on retirement planning, and then risk management or insurance, and estate planning, and finally we'll end up the season with a case study. So for today's workshop, we're going to look first of all at the total gamut of the taxes we pay. And then we're going to look at the recent federal tax acts. It's been an exciting year for various reasons and a lot of activity going on. Then we will end up with some tax saving strategies, some fairly basic that you are aware of already, but we'll also look at some other ones that you may not be familiar with. So what taxes do we pay? Well, at the federal level, obviously we pay income taxes on all of our earned income, interest, short-term, long-term capital gains taxes are treated differently. Also qualified, non-qualified dividends. There's a net investment income surcharge that's been tacked on now since Obamacare. And also we're going to be looking very quickly at the impact on estate taxes. At the state and local level, there are obviously for most of us income taxes and also sales tax and property tax. State of California probably has the highest income tax rate in the country, and some folks are upset with this and figure that they might want to look at moving to a state that has lower state income taxes or even none. But you have to be careful because all of the states need to raise funds from somewhere. Somebody has to pay for the roads, for the libraries, the police department, and so on. So if there's no state income tax, they'll probably make it up on the sales tax or the property tax. So anybody looking at moving needs to consider the total picture. Look at the sum of all three of them. Because that's what determines what you're really going to be paying. Okay, so first of the federal tax acts that we're looking at today is going to be the Tax Cuts and Jobs Act, the TCJA. That was actually signed into law back in December of 2017 and was effective for 2018. And the first time most people saw the results of it would be when they were filling out their tax returns in early 2019 for the previous calendar year. It's regarded as one of the most significant revisions to the tax code in 4 decades. And most of the items that are in the TCJA sunset in the end of 2025. That was necessary in order to get the tax law to pass with the items that the Congress wanted to include. That applies to the personal items, but not to the corporate taxes. There's a big change in the corporate taxes, where the rates were cut from the 35% maximum prior to the TCJA down to 21%. That's for the maximum that the TCJA included. There's some notion that with the Biden administration, this may revert back to somewhere in the region of 28% in the future. That depends a lot on the Republican control of Congress, or they may not allow a tax increase back. So this is uncertain, but I'm just putting it here to keep in mind for future. Okay, so what are the tax brackets and the rates that are included in the TCJA? All of the rates here shown on this column on the far left are in fact reductions over the previous law. The maximum prior to that had been just over 39%. The maximum now is 37%. And I've given you all of the brackets that this applies to for both 2020 and also for 2021. When folks were first filling out their tax returns in April, or probably just prior to April of 2019, some people were surprised that in spite of the name, the Tax Cuts and Jobs Act, that their taxes had actually risen. But the reason for that is because the tax brackets changed along with the rates. So, for some folks, it may be in a lower rate, but move to a different bracket where they wind up paying more taxes rather than less. For capital gains, is driven now by your taxable income. For single people, filing single, anybody making with a taxable income making less than $40,000 a year pays no long-term capital gains, and also no taxes, 0% on the qualified dividends. Short-term capital gains, I think, are still taxed as at the ordinary income level. That's for folks filing single for less than 40,000, or married filing jointly less than 80,000. Then in the range from, well, I've shown you the ranges here from 40 to 440 and change, and for single, and for 80,000 to almost 500,000 for married filing jointly. Short-term capital gains are still taxed as ordinary income, but they pay a 15% rate on long-term capital gains and qualified dividends. If you're making over those limits, then you're going to pay the maximum for capital gains and qualified dividends, which is 20%. It's still way less than the maximum rate for ordinary income. One of the big changes in the TCJA was for the standard deduction. Prior to the act, for folks filing single, the standard deduction had been $6,500. That's what it would have been, I think, in 2018 had the act not passed. For married filing jointly, it would have been $13,000. These got almost doubled, and currently for 2020, it's just over $12,000 for single and almost $25,000 for married filing jointly. And there's a slight change from inflation for 2021. And in addition to that, there's for folks age 65 and over, they got a slight adder, a small adder, and that has been retained. It's a little bit higher now than it was prior to the Tax Act, but it's not huge. On the other hand, the personal exemption that used to exist, on the old tax structure is now gone. It used to be that for single people, you had an exemption, or would have had an exemption in 2018, just over $4,000 and $8,300 for married filing jointly. That has now been eliminated. So I guess the net result from all of this is certainly a simplification, which was one of the goals of the Act. But also, I think folks come out a little bit ahead with the standard deduction as high as this. A lot of people that used to have to file with itemizing their deductions can now get away with the standard deduction. So it's probably useful in that regard. Looking at the itemized deductions, this is just going down the list in the order in which they appear on the 1040. The medical deduction used to have a floor of 10% of your adjusted gross income, so that anybody making or with a medical deduction of less than that did not get to deduct anything. that was reduced with a TCJA to 7.5% for 2018. I think the plan was originally to bump it back up to 10% again after 2018, but in practice, Congress has, I think, passed a further act to keep it at 7.5%. I'm not sure if that's permanent or if it's just for the current year. The big change that occurred for the TCJA for most of us in California, at least, and in the high state tax areas on the East Coast and the West Coast, California and New York and such states, was a limit on what you can deduct for state and local income tax. The so-called SALT deduction is limited to $10,000. That includes the state and local income tax and property taxes. So regardless of how much you're paying in state taxes, and many of us are paying well over $10,000 for the state income tax, you're limited to a deduction of $10,000. Small change in the mortgage interest that you can deduct. It used to be that you could only deduct interest on properties up to a value of $1 million. That's been reduced to properties that with a maximum interest mortgage of $7,500. And also the interest on home equity loans is now only deductible if the loan is used to build or improve your home. Gifts to charity are still deductible. There's no big change there, but the deductions, miscellaneous deductions for tax preparation, theft, and casualty losses, these have all been eliminated. They're not available anymore. And then the final item on your old Schedule A for itemized deductions is that the P's limitation has been eliminated. That's the phase out in deductions that had applied so that folks with a large list of itemized deductions in the past would find that some of them were removed by the so-called P's limitation, and that's now gone. Estate tax is again a big change. The old exclusion from state taxes of roughly 5 million, I think it was 5.5 million or something in that area prior to the TCJA, has now been bumped up to 11.5, well, just over 11.5 million in 2020 and 11.7 in 2021. And it's also portable to be used by the second spouse to pass. So that's almost a factor of 2 there. And it means that for many people, their estate taxes will fall below this number and they will have 0 tax to pay. The maximum rate is set at 40%, and there are lower rates starting at just over the exclusion amount. The big challenge that I see here is, how do you estate tax planning is obviously inherently long range, and how do you do that planning with a tax law that sunsets in 2025? Planning to die before 2025 in order to get the benefit of the larger exclusion does not seem like a winning strategy. I put a little hint in here, though, that estate tax planning has far more to do with a bunch of other stuff over and beyond saving taxes. Saving taxes is just one aspect of it, but this change in the exclusion, the major change in the bump up in the exclusion that's available until 2025 does make it difficult to do estate tax planning, and some folks might regard it as the state attorney's long-term employment act. It's going to be a lot of work for the estate planning attorneys to keep tracking this over the next few years and rewriting a lot of wills and trusts. Other miscellaneous issues that were included in the TCJA include the Roth IRAs. There's a change there. It used to be that folks could do a conversion from a traditional IRA to a Roth in 1 year, and they had until the tax filing date of the next year when they would be filing their tax return, to decide if they wanted to leave that change, that conversion in place, or to undo it, known as a recharacterization. And that was a big benefit, because if the funds that were converted had gone down and you already paid taxes on them at the conversion, it might be a useful exercise to undo that conversion and not have to pay the taxes on the larger amount, and then redo it later and with the lower valued assets, and have lower taxes to pay. But that whole thing is now gone with the TCJA. And once a conversion to a Roth has been done, it's cast in stone. It's a done deal. You can no longer undo it. The other change that comes in are alimony payments. It used to be that these were deductible to the paying spouse and had to be reported as income by the receiving spouse. That's no longer the case. It's the other way around now. They're not deductible to the paying spouse, and now the receiving spouse no longer has to report them as income. There were also changes to the AMT exemption, and the net effect of these changes really was to make it so that fewer people now need to file the AMT tax returns. That's another simplification. Maybe hard one if you're paying more taxes, but it does make life a little bit simpler. So I've given you the numbers here for that, for anybody that had been affected by AMT before. Okay, so moving on from the TCJA, we're going to look at another of the federal laws. This is the Secure Act, the Setting Every Community Up for Retirement Enhancement. I've no idea how long Congress spent working on these titles in order to get a slick acronym for it. But this one was passed at the very end of 2019, and it's effective as of the beginning of calendar 2020. And it was regarded as the largest retirement change since 2006. It mostly affects IRAs and both the traditional and Roth, and also the RMDs. RMDs, the required minimum distribution, it used to be that once you turned 70 and a half, that you had to start taking your required minimum distribution. And there's a draconian penalty if you fail to do that. You'd have to pay 50% in penalty of what you would have had to take for that year. The age has now been moved out to age 72, which makes life a little bit simpler. And I believe the RMD tables that the IRS has put together have been updated as well. So the bottom line is the amounts that you'll be required to withdraw each year after age 72 are slightly less than they would have been prior to the Secure Act. It's not a huge change, but every little helps, and it is useful. And that applies to everybody who would have turned 70 and a half by the 1st of January or in 2020. And in essence, those people who were born on or after July the 1st, 1949. Also, in traditional IRAs, there used to be an age limit that you could no longer contribute to an IRA, even if you were still working and had earned income, and that age limit has now been removed. So if you've earned income for the year, you can contribute to your traditional IRA regardless of your age. There's a big change in the Secure Act for inherited retirement accounts. It used to be that anybody inheriting a retirement account had the ability, if they did things properly, to stretch the payments all the way out to based on their own age. So if a younger person inherited the IRA, they could stretch it out to their own age 70 and a half. and make very, very, very low withdrawals, in the early years. That in essence is gone, except for a few special cases. It's no longer possible to stretch an IRA except for the surviving spouse of the original owner. That's the one big exception. A minor child can stretch it for a few years up to the age when they reach majority. There's also an exception for people who are more than 10 years younger than the decedent, and for disabled people or people who are chronically ill. But for most folks, the stretch IRA has gone, and it's been replaced by a 10-year rule, which says that there are no required minimum distributions for the 10 years, but the account must be totally depleted by the end of the 10th year. So the IRS is not telling you how to do it anymore on a year-by-year basis, but you can't hold on to the account for longer than 10 years. By the end of the 10th year, it must be totally driven to zero. Okay, another of the federal acts in 2020 was signed on middle of March, and became effective on April the 1st. And this is the Family's First Coronavirus Response Act. What this was done to try to help employers and employees that were being hit very heavily by the virus and by the quarantine rules. It mandates that every employer must provide leave to their employees if they get hit with the illness from the virus or required to quarantine, and it provides tax credits for the employers for up to 2 weeks of payroll, which allows the employers to keep these workers on their payroll, and it also allows the workers to avoid the tough decision, if they're ill, of whether they have to go to work anyway because they need the paycheck and put the public at risk doing so, or whether they're going to do the honorable thing of staying home and not infecting all their co-workers. So now there's a 2-week period that the employer is reimbursed for those payroll amounts. The credits are also available for those who are self-employed. The CARES Act, the Coronavirus Aid, Relief, and Economic Security Act, again, a stretch to get to the acronym, was signed about 10 days later than the previous one. And it was a huge stimulus act. In fact, I think most folks see it as the largest stimulus package in our history. It was $2.2 trillion, trillion with a T. And it was actually amounted to about 10% of our total GDP, which means that there's a big addition, obviously, to our debt structure. One of the biggest items in there was to help those folks who were made unemployed by the virus. It adds an extra $600 per week to the unemployment benefits over and beyond what the state benefits were being paid. Benefits lasted for up to 39 weeks, which takes us to the end of this year. Is also available to gig workers. This is being worked on by Congress currently as we speak to see if they can reinstate some of these benefits, as they are running out, and to avoid a cliff for those folks who are unemployed. There's stimulus checks that were mailed out, grant of up to $1,200 per adult and $500 per child, available to workers who had an AGI of less than $75,000, but that got phased out between $75,000 and $99,000. So folks above that limit would not have received a stimulus check. There's a new wrinkle made for charitable donations. It used to be that the only way you could get a deduction for charitable donations in the past was to itemize your deductions, and for those folks who, for various reasons, did not itemize, they did not get to take a charitable deduction. But with the CARES Act, up to $300 in a cash donation, it had to be in cash, is deductible above the line, so that even people taking a standard deduction can, in addition to that, remove up to $300 from their income, from their taxable income. But that's only for donations made in cash. Does not apply for any items that were donated. Also, there's a PPP, Paycheck Protection Program for small businesses, where they could receive a loan for up to 8 weeks of expenses, and this was to hopefully allow them to keep employees on their payroll. And if the loan was used to pay for payroll, rent, and utilities, then by filing the appropriate paperwork, the loan was converted to a grant. The paperwork is not trivial. There's a fair amount of work involved in making this happen, but it certainly was useful for a lot of small businesses. Further changes for the CARES Act. It allows people who are affected by the virus to take a loan from their IRA without paying the 10% penalty. There used to be a 10% penalty for early withdrawals before age 59 and a half, and for amounts up to $100,000, that does not apply. The CARES Act made it okay to give yourself a loan from your IRA for up to $100,000 and not have to pay the early withdrawal penalty. However, you still have to pay taxes on the amount that was withdrawn. But the IRS or Congress has given us a tax break as well there, where the taxes can be stretched over a 3-year period from 2020, 2021, and 2022. And if the funds can be paid back into the IRA account within that 3-year period as well. That makes it a little bit easier for people to take a significant loan from their IRA without the hit that used to be built into it. There were changes also made to the required minimum distributions for IRAs and for 401ks. For the calendar year 2020, those have been waived, and it was possible in the early part of the year for folks to, if they had already taken their RMD, to pay it back into their IRA or 401k, but that process expired at the end of August, so it's no longer available. And this also applied, I believe, to inherited IRAs. Initially, there was some confusion on that, but I think there's been enough written on it since in later months to conclude that it does in fact apply to inherited IRAs. Okay, so that pretty much wraps up what I wanted to say about some of the various tax acts that have passed over the last few years. And obviously, the whole tax environment has shifted significantly. I hope I've given you a reasonable look at some of the major items there. But now we're going to move on and look at hopefully at a few ways that you might be able to save on the taxes that you need to pay. I'm going to start with the basics. With everybody who has earned income should consider either a traditional IRA or a Roth IRA. Traditional IRAs, you can make a contribution of up to $6,000 in 2020, and also the number does not change for 2021. Plus, you get to take an additional $1,000 in contribution for age 50 and older. This contribution can be deducted, from your taxable income, except in a certain case, and that is if your modified adjusted gross income is above $65,000 for singles or $104,000 for married filing jointly, and you have an employer plan that covers you. You can still make the contribution, but you can't deduct it. If your MAGI is above those limits. Besides the deductibility of the contribution, the growth is also tax deferred. So all of the appreciation for the funds inside the IRA, the taxes are deferred on that. But, and this is a big but, every penny that's withdrawn, when you finally start to draw down on your IRA, would be taxed at the ordinary income level, which is your maximum tax rate. So that's a little bit of a gotcha that you need to be prepared for in doing your retirement planning. In essence, you only own part of the IRA. Uncle Sam owns a major chunk of it and will demand his cut when the time comes. For a Roth IRA, it works the other way around. The contributions are not deductible on your tax return, but every penny of appreciation and for the distributions are tax-free, subject to some fairly easy requirements to meet. You must have owned the Roth for over 5 years, which is not a big deal for most people. However, there are income limits on which limit your ability to make a contribution to a Roth. The income limits means that your ability to contribute to the Roth gets phased out between $124,000 and $139,000 for singles, and $196,000 and $206,000 for married filing jointly. I think those limits are inflation adjusted, so they go up a little bit each year. The other way, of course, of getting into a Roth, if you don't qualify because of the income limits, if the income limits disqualify you from making a contribution to the Roth, you can still attempt to do a backdoor Roth where you make the contribution to the traditional IRA, regardless of what your income is or how high it is, and if you probably will not be able to take a deduction for it, but then you can do a conversion of that amount over to the Roth. And this is not quite as simple and straightforward as it sounds, because there are various limits that make this a little bit tricky to do in practice. But for those folks who want to contribute to a Roth, it's probably at least worthwhile looking into the details of it. We'll cover this a little bit more in our later workshops on retirement planning. Okay, there are changes made for the employer retirement plans as well, for 401ks and 403bs, simple plans. For the 401k and 403b, the contribution limit is $19,500, and there's an additional contribution of $6,500 for age 50 and older, which takes you up to, I guess, $26,000 per annum. That's obviously a sizable chunk of change, and you can build up a very significant 401k that way. Just like the traditional IRA, the growth is tax deferred, but the distribution is taxed at the ordinary income level again. So the maximum hit when you start pulling money out. Simple plan, again, set up by your employer, allows you to contribute up to $13,500 And again, a $3,000 addition for that, for those folks who are 50 or older. Limits are a little bit lower than for the 401k, but it gets treated the same way. The growth is tax deferred and the distribution is taxed at the ordinary income level. Another somewhat similar plan is the health savings account. I think this is one of the best kept secrets out there. I know very few people who have done it, who use one, but it's actually the most beneficial of all of the retirement plans, provided you stick within the limits. To be eligible to make contributions to an HSA, you must have a high deductible health insurance plan. And that means that you cannot be on Medicare. Anybody on Medicare automatically will be disqualified from using an HSA. But for younger folks, that have elected to go with a high deductible plan. High deductible normally means that your deductible is something in the region of maybe $20,000, for the year, that you pay all of your health costs up to that amount. It's only for major surgery and stuff like that beyond the $20,000 limit, that the plan gives you coverage. But for folks who have elected to go that way anyway, just because it gives you a much cheaper annual premium, you get some huge tax benefits. It's a triple tax benefit. The contributions are tax deductible, the investment grows tax-free, and the distributions are also tax-free, provided they're used for medical expenses. And the medical expenses, a fairly broad definition of that. And it will also include, premiums, your Medicare premiums and stuff like that. So that just because you can, and just because you're not allowed to make contribution to it on Medicare, you can still make your distribution from it. So it's a way of paying for your Medicare premiums along with other expenses on a totally tax-free basis. Triple tax benefits, hard to beat. Contributions are fairly limited. You can only contribute up to $3,550 per person, or $7,100 for family each year, and then there's an additional $1,000 catch-up for age 55 and older. Not huge numbers, but you can still build up a sizable HSA account while you're working and have that available for when you retire. A lot of folks are actually use it, in spite of the name, as a retirement account, because you can make all of the contributions while you're working. You don't have to use the account for out-of-pocket expenses. You can still pay your out-of-pocket expenses by writing a check, and just keep adding to the balance in your account, and then have a sizable account available when you retire, and when you're no longer working and you can no longer contribute to it, you can make all the withdrawals. So it's something to consider for the younger folks. One of the things I draw folks' attention to, and most people are familiar with the differences in tax efficiency of various assets. The CDs and bonds and REITs and all this stuff are very inefficient assets from the tax perspective, because they spin off interest that's taxable. Some of them spin off non-qualified dividends, short-term, any stocks that you hold on a short-term basis. That's a very inefficient way of doing it from the tax perspective, because you're going to get taxed at the ordinary income tax level, the maximum rate, which can be as high as 37%, as we saw earlier under the TCJA. So these kind of assets really belong in a tax advantaged account. These are maybe appropriate for your IRA or for your 401ks and stuff like that. Tax efficient assets like muni bonds or stocks that are held for long-term capital gains, or assets that spin off qualified dividends, are going to be taxed we saw earlier at a maximum of 20%, a reduced preferential rate. It could even be 0% or 15%, depending on what your total income is. We saw in one of the earlier slides. So these are suitable, obviously, for your taxable accounts because you get a tax break on the gains. So what accounts should you hold these various assets in? We've basically got three different types of accounts. You've got a traditional IRA, where we saw before, where it's a tax preferred account where the contributions are deductible, but the distributions are taxed as ordinary income. At the other extreme, you've got the Roth IRA, where the contributions are taxed before the money is contributed to the Roth IRA, but there's no tax paid on the withdrawals. Then in between, you've got your taxable account, which is kind of a mix of the two of them. The income is taxed prior to being contributed, so it's kind of like the Roth, but the distributions from your taxable account can get a tax break. If you manage it well and look for long-term capital growth in there, and then you're going to be paying a lot of the gains as long-term capital gains taxed at the preferred rate. And for an inheritance, there's a big difference in these as well. If you inherit a traditional IRA, it's the worst form to inherit, because you're going to be paying taxes at the ordinary income level on every penny that you withdraw from that. Whereas the Roth IRA is the best way, the best item to inherit, because there'll be no taxes owed on that. So that makes an effective difference in the value of the account that you inherit. The taxable account is again in the middle. It's actually closer to a Roth than most people realize, because the current law says that on inheritance, the assets receive a step up in the cost basis to the value on the day of death, so that there are no taxes owed if it's sold immediately, just similar to the Roth IRA. If you hold it beyond that, then you'll only pay taxes on the appreciation from the day of death onwards. So taxable accounts make up a useful way of passing assets on to the next generation. The bottom line on this, I guess, is that the traditional IRA is the worst in this regard, so you should keep that in mind. So which assets should you put where? Since on the traditional IRA, you're going to be paying taxes on the distributions at the ordinary income rate, you may as well put the tax inefficient funds in there. You're going to be paying the taxes anyway. On the other extreme, for the Roth IRA, where you won't pay any taxes on the distributions, you may as well load that up with the high growth assets. Typically, you might want to put small cap funds in there, REITs, emerging markets, whatever. These are typically the high risk assets, where hopefully the high risk also means high growth. The two tend to go together on a long-term basis. So your Roth IRA is a good place to hold those. And then in between, for the taxable account, as we've said before, you put the tax efficient assets in there. Use that for any capital, any stock funds where you're prepared to hold them on a long-term basis, and mostly index funds are very appropriate there. Some of the active funds probably may do too much short-term trading, so you need to watch where you put those. So if this is not a cast in concrete thing where there's a brick wall between the three of them, and you won't be able to do it absolutely perfectly the way you would like to do, but most of the data that I've seen says that if you load up the various accounts with the appropriate assets to the best of your ability, you can save up to 1% per annum on the as an increase on your after-tax returns. It's not a huge change, but over long term, it could make a big difference. Up to 1% is not to be sneezed at. Tax loss harvesting is something that a lot of folks are familiar with. The goal there is to, if you have any, at the end of the year, if you have any assets that have taken a beating during the year, you may want to consider selling those and taking the tax loss and using that to offset any gains you might have in other funds. And you can even offset up to $3,000 on your ordinary income. And any excess losses beyond that can be carried forward to future years to reduce your gains there. Now, after you've sold the asset at a loss, if that gives you an unbalanced portfolio, which it's likely to do, you may want to rebalance your portfolio back to whatever long-term strategic asset allocation that you'd chosen to go with by buying a similar security to the one that you sold. You need to be careful of the wash sale rule, which says that you cannot you cannot take a loss for any sale that you've made if you've purchased a substantially identical security within 30 days before or after you made the sale. One of the problems that I see with this, some folks don't work through on a longer term basis, is that it's nice to be able to take the loss in the current year, and it's certainly useful. But the price you pay for that is that your cost base is going to be reduced. So going forward, so you're going to pay higher taxes when you eventually sell off some of the other assets in your portfolio. And what you're really doing is delaying paying taxes, not eliminating it. But there is one case where you may, in fact, actually eliminate it, and that is that if you use this technique for assets that are destined as legacy investments, for a fund that you figure you are probably not going to need it in your own lifetime, and if you figure to pass it on to the next generation, if it gets the bump up in cost basis that's the current law, then you get to use the tax loss now in the current year without having to pay the penalty of a lower cost basis in future years. So I see this as being most beneficial for legacy investments. You can use tax bracket management techniques, for folks that have. It's particularly useful, I think, for folks that have lumpy income, where they have high income years and low income years. This might be for somebody who's doing consulting work, or maybe you're deliberately shifting income and expenses around to create this effect. But if for any reason you find yourself in a low bracket year, it may be worth considering harvesting some capital gains and paying taxes on them now in the current year at the lower rate, and rather than risk having to pay higher taxes in a future year. This would be particularly true if you're in the zero. If your income is low enough to put you in the 0% bracket for long-term capital gains. This can also be used besides harvesting capital gains. If you're doing a Roth conversion, you may want to convert over enough from your traditional IRA into a Roth to fill up the current low bracket that you're in. When you're doing this, though, you do need to be aware of the Medicare brackets, because if you bump up to the next Medicare bracket, you may find that you're suddenly paying an IRMA, a income-related monthly adjustment amount if your MAGI exceeds certain limits. I'm going to look at those limits in a minute, but in essence, your MAGI is the AGI off your 1040 form with the tax-free income added back in. And if the base for 2020 is $87,000 for singles and $174,000 for married filing jointly. So if you need to watch these limits as well as your the tax brackets that show up on for your 1040. This table shows the IRMA that you have to pay for various MAGI levels. As we said before, if you're below $87,000 for single or $174,000 for married filing jointly, you do not have to pay an IRMA. But if you exceed those limits, then the lower bracket you pay an additional $57.80 per month extra on your Medicare Part B payments, and an additional $12 and change for your Part D, which are fairly low numbers. But as your MAGI goes up, increases, these numbers increase significantly. Now at the highest level, which is $500,000 for singles and $750,000 for married filing jointly, you then have to pay an IRMA of an extra $347 a month for Part B and $76 and change for Part D. This is on top of the $146 a month. I think that's what it is for 2020 that you pay as the base for Part B. So these numbers obviously add up significantly. If you do fall into any of these higher brackets, you can find yourself paying an additional $5,000 or $6,000 a year for your Medicare premiums. So if you're trying to manage your tax brackets, you don't want to slide accidentally into one of these. You may elect to do it, but you should do it knowing full well what the cost is of doing it. The other thing you need to recognize is that these are not phased in. This is a tax cliff. If you go $1 above the limit, it puts you into the next bracket. So that could be an expensive dollar that you added into your income. I've also given you the same table, the same set of data for the 2021 tax year. Recognize that the MAGI that the IRS is or the Medicare is looking for here, they take those numbers off the prior tax returns from 2 years ago. So for 2021, they will look at your 2019 tax returns. And again, you're looking at significant dollars if you find yourself in these higher brackets. I want to talk about charitable giving for a minute for those folks who are charitably inclined. There's a qualified charitable distribution, a QCD, that can be useful. And if you make a donation directly from your IRA to the charity, you do all this properly, it does not show up on your 1040. It doesn't add to your total income. Normally, if you make a donation, let's just say from a regular taxable account or something like that, it doesn't show up on your taxable income, but it does show up on your total income at above the line and on your AGI. So even though you get to deduct it before you get to the taxable income and you don't pay taxes on it, if it's just a regular donation, it can bump you up for your AGI and therefore into a higher, it has the potential to bump you into a higher Medicare bracket. But if you do it as a QCD, that risk is no longer there because you report it on the 1040, but it doesn't add into any of the numbers and does not show up on your AGI, and therefore there's no risk of a Medicare increase. Also, for those folks who have to take RMDs, the QCD counts against your RMD, so it solves that issue. This is especially useful for those taxpayers who use the standard deduction, the higher standard deduction that the TCJA gives you, because it keeps the total income on your 1040 down at the same time as giving you the higher itemized or standard deduction. There's a limit of $100,000 to the maximum contribution that you can make. And there's another more, actually I see it as a fairly serious, unfortunate limit, and that is this has to go directly to the charity. You can't use a donor advised fund and have it count as a QCD. You can still make contribution to a donor advised fund, but it will act just like a regular charitable contribution, and it could potentially bump up your Medicare brackets. The other thing, of course, you can do is that's useful is to make a contribution from a taxable account. If you contribute stock, the actual shares rather than selling them and then contributing the proceeds. If you contribute the actual stock, you don't have to pay the taxes on the gain. With that larger deduction that's available from the TCJA and the SALT limits that we discussed earlier, it may make sense for some folks to try bunching their deductions. I've shown you two different cash flow streams here. One doing it the old way where you don't bunch, and then what happens when you bunch them. These are all totally hypothetical numbers, but supposing your return showed in the first year, the $10,000 limit for the SALT, and you wanted to make $1,000 a month charitable contribution, so you got $12,000 for the year, and here you do not exceed the standard deduction, so you take the standard deduction instead. That's a better deal than the $22,000 that you get this way. And the same thing goes for year 2 and year 3. So at the end of the 3-year period, your total deductions will be $74,400, and you'd get the tax saving that comes with those deductions. If, on the other hand, you tried bunching all 3 years of your charitable deduction into the first year, you'd have a $36,000 charitable contribution here, let's say to a donor advised fund, just as an example, and you'd still have your $10,000 SALT deduction, so you'd have $46,000 deductions if you itemized for that year. And then for the years 2 and 3, the second and third year, you would make no charitable contribution, so you would then take the standard deduction of $24,800 for each of those years. And over the 3 years, you now have a $95,000 and change total deduction, which is a $20,000 plus improvement over the deductions you'd have for that 3-year period and the tax savings that go with it. It's a technique that can work quite well for folks that are on the edge, and it works best, I think, if you're using a donor advised fund, because for the donor advised fund, you get to take the contribution, the deduction in the year in which you make the contribution, but you can make the grants over time at your leisure in subsequent years anytime you want. So you can get the benefit of the contribution, but you can decide later where the funds should go to which specific charities. You may also want to consider lifetime gifting to get funds out of your estate. And for funds that are destined to go to various heirs at a future point, if you don't need the money yourself, you can make gifts to them each year and there's without paying any taxes on it. And there's a $15,000 per person limit, or a couple if they combine their gifting strategy can take $30,000 per couple. And this can be to as many recipients as you want, for your children or your grandkids or whatever. It doesn't even have to be relatives. It can be friends or anybody you want. If you make these contributions, you can take a significant chunk of change out of your estate and avoid any of the issues of estate taxes on at a later point. One of the things, though, that you need to do is if you exceed this dollar amount in any one year, you need to file a disclosure on Form 709 because the excess amount, you don't have to pay taxes on it, but it does reduce your lifetime estate tax, the exclusion for that. It comes out of that. And the other thing that you can do is make contributions for if you want to pay your grandkids college expenses or stuff like that. If you make contributions directly to the providers, or for medical expenses, same thing. You can make contributions directly to the providers as a way of getting cash out of your estate on a non-taxable basis. This may not be top of the list for a lot of folks today because they may be thinking of the large estate tax exemption. If you're looking at $25 million or whatever it is for a couple with the TCJA, it may not be important to reduce stuff from your state in that regard. But don't forget that sunsets in 2025. And the other thing you need to keep in mind is that estate taxes are paid on the gross estate. They do not take the mortgage or other liabilities into account. So in the Bay Area, a lot of folks are sitting on homes that are worth $2, $3, $4 million, perhaps in some cases. Even if you have, say, a $3 million home and a $2 million mortgage, the estate taxes are built on the $3 million, not the $1 million equity that you have in it. So it's not all that difficult to get up to to get beyond the estate tax exemption, especially if it gets reduced in future years. So what I've given you here is a list of reading material that maybe goes into more detail on some of the things that we've discussed, and also I've given you some websites that may be useful. So if you download the slides, you'll have access to all of this reading material and other information. I kind of like Wade Fowler and Bob French are guys that do a lot of work on retirement planning, and this is their website here. It's worth visiting there, and also Mike Piper and Rick Ferry. So you may want to explore some of this a little bit more. And finally, we end up with our cartoon, which in this case, they've got a guy peddling blank charity donation forms, receipts backdated. I think this is maybe a month early. We're doing this in December right now. It may be appropriate for next month, but I think it sums it up well. So that's it for this workshop, folks. Thank you for joining me, and we hope to see you in the next one.